Maximize Business Value podcast. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition their business on their terms. Our mission was born from the lessons we've learned from over 100 business transactions, which fuels our desire to share our experiences and wisdom so you can succeed. Now here's your host, CEO of Mastery Partners, Tom Bronson.
Hi, this is Tom Bronson, and welcome to Maximize Business Value, a podcast for business owners who are passionate about building long-term, sustainable value in their businesses. Today, we welcome my close friend, Craig Beck. He's the owner of Beyond CFO. Craig and I have been acquaintances for several years, but have really gotten to know one another over the past 2 years through our accountability group, the Rogue Forum, which is probably aptly named for the group of folks that we have in it. It's part of Business Navigators, the servant leadership group here in Dallas that you hear me talk about frequently. Craig has an interesting background that is so helpful to his clients, but we'll talk about that in a moment. Today, we're going to focus on two really important topics that business owners should really understand and use to their advantage. EBITDA, which is earnings before interest, taxes, depreciation, and amortization, and working capital. Both of these topics are extremely important to any business owner who is planning to exit, whether now or in the future. So, welcome to Maximize Business Value, Craig.
Thanks, Tom. Appreciate the opportunity to be here.
I'm so excited for this conversation. You and I have been talking about doing this for a long time. So before we get into the details of what we want to cover today, tell us a little about Beyond CFO.
So Beyond CFO is my company, and we show owners of middle market companies how to improve the value of their company by focusing on the gap between the company's current status and the owner's vision of the company. And we identify and resolve issues at the intersection of engineering operations, legal, and financial areas.
Engineering operations, legal, and financial areas. That is a wide spectrum there. I know we're going to talk about your experience in a second, but I have to say you're singing my song. Any business like yours that'll help business owners really realize their vision and maximize the value of their business, that is great in my book. So what is your background and why did you start Beyond CFO?
So the breadth of my background is actually one of the things that I suggest to potential clients that I bring to the table that a normal CFO doesn't not a normal CFO. I'm a normal CFO, but they don't typically bring the breadth of experience that I do. I started as an engineer. I did that for a couple of years, focusing on the economic impact of whatever engineering change I was about to make. So kind of half business, half engineering, which is what really industrial engineers do. Then I went back to school and became a securities attorney and help people raise money and improve their capital structure. And during the latter part of practicing as an attorney, I got my MBA in finance at Carnegie Mellon. So I've always focused on the economics. And I started Beyond CFO when I left Heller Financial in 1998 to help a client improve his capital structure by going public through a $1.8 billion master limited partnership. That was a big number then. It's a small number today. But I've been helping owners of companies with revenues between 5 million and 150 million realize the vision for their company ever since. Some of the recent examples of what I do are, we've reduced an owner's tax liability by over $600,000 through getting some R&D credits for him, changing the company retirement plan, and getting him involved in private insurance. We've uncovered fraud that cost the company a little over $2 million. We raised $1.8 million for 2 partners to buy out 6 other partners. We raised $10 million to build a new processing plant, which will more than double the EBITDA of that company. And we'll talk about EBITDA in a minute. Those are kind of the notable ones. There are a lot of other relatively minor ones that actually over time improve the company value as well. So those are the kinds of things that we do.
Wow. That, by the way, 1.8 billion, did you say 1.8 billion?
Right.
Yeah, that's funny right there. Small money, sure. Yeah, 1.8 here, 1.8 billion there. Next thing you know, we added up to some real money. So,
Right.
so sounds like you might get bored pretty easily. Engineering and then law degree and then finance. Do you bore easily, Craig?
No, I love to learn though. I really do love to learn.
Yeah, it's kind of fun, isn't it? I'm a lifelong learner. I love to read books, as one of my friends, Jim Roddy, always says. Buying books are a $15 way to get an MBA, and so I love that. I'm a voracious reader, but you are way over degreed to compared to me. I got nothing. So congratulations on all of that hard work. So let's get into the topic at hand. I'd venture to guess that most business owners know what EBITDA is, but would you give us a quick explanation of what EBITDA means?
Sure. As you mentioned before, it's earnings before interest, taxes, depreciation, depletion, and amortization. And so to break that down, earnings, just so you know, is net profit. So the bottom of your P&L is where we start on EBITDA. Then it's before interest. So you're going to essentially add back interest, which is the non-principal portion of payments on debt. Then taxes, but we're really only talking about income taxes. So if you got some state and local taxes that really aren't involving income, that's not the kind of taxes that you're going to add back to get EBITDA. And if the entity is a pass-through entity, there won't be any taxes because that'll show up on the owner's tax returns. Depreciation, depletion, we're talking about GAAP, not tax depreciation here, and that's significant these days since you can write off very rapidly things that you buy. Like a perfect example is equipment, and so you can accelerate that depreciation. But we're talking about GAAP depreciation here, which is generally accepted accounting principles. Depletion falls in the same category, but really only applies to things like oil and gas or mining, where you have minerals that are depleting. But we are in Texas, so I thought I'd mention that since we do a lot of oil and gas here. And then finally, amortization, which is similar to depreciation, but it applies to things like goodwill, non-compete agreements, government permits, and those sorts of things that are associated that a company would have whenever it has purchased another company. And so those are the elements that get you to EBITDA. Again, earnings before interest, taxes, depreciation, depletion, and amortization.
So an interesting point that you just raised, and the whole depreciation issue. So when you get that kind of bonus depreciation, it seems like every year Congress is allowing, what is it, Section 179 bonus depreciation for things. So when you're looking at EBITDA, you should normalize it for the normal GAAP depreciation versus the bonus depreciation, correct?
Correct.
Okay. All right. I want to be sure that that's a nuance that people don't really think about because you can buy new equipment and put it in use and take bonus depreciation for tax purposes, but that doesn't satisfy GAAP accounting. It's worth explaining that a little bit further. So why don't we just use EBITDA, or why would we use EBITDA versus just net profit? I mean, wouldn't net profit really be the indicator of the earnings of a business?
Well, in this case, when we're talking about a business transition, the objective is to estimate what funds are available to pay the capital providers, either the investors that are buying the company or the banks that are supplying debt. So what you're trying to do is see what free cash flow would be available. And so we're typically talking about looking at the GAAP-based accrual financials, which has a smoothing effect versus the lumpy cash in, cash out of cash financials. And we're trying to adjust it to exclude non-cash items that are cost of the business that are borne over time. The best example of that is one we just mentioned, which is depreciation. So, and that's essentially what depreciation is doing. It's trying to account for the decline in value of the equipment as it wears out, but realizing that that's really not taking cash out of the business on a weekly, monthly, quarterly basis. And so we're going to adjust for that since it's not really a cash item.
Okay. All right. Well, that makes a lot of sense. Now, I typically recommend to my clients, just for simplicity's sake, to actually move those items, the income taxes, depreciation, amortization, move those items below the line so that you can see really what the net operating profit is for the business. And you actually get a picture roughly of what your EBITDA is right on your financial statements. So would you say that that's a reasonable practice?
Actually, for my clients, I usually, so when QuickBooks, for example, produces your P&L, I usually take that and add the calculations to the bottom of the P&L that essentially get you to EBITDA. So because I use that in other ratio analysis that I do whenever I provide like a monthly report, monthly financial report and ratio analysis to my clients so they can understand what's happening in their business through their financial statement. So absolutely, I agree with you.
Awesome. One of the biggest reasons why businesses don't transact, and as I've said on this show and throughout our website and pretty much everywhere that people listen to me, 83% of attempted business transactions fail to reach the finish line, meaning only 17% get there. And one of the biggest reasons that 83% fail is because business owners really don't understand how their business is valued, or they've heard something on the street, or they're trying to apply something that they read about some major acquisition. Google bought some company, and so they're trying to apply those multiples to their own business, and it just doesn't apply. But I also hear frequently folks saying, well, I'm going to get a multiple of my revenue. I want 2 times revenue or 3 times revenue, which is an applicable methodology for a very small fraction of businesses. But 97% of small business transactions, and when I say small business, I'm talking about anything less than 100 million in revenue, kind of that lower middle market and down. 97% of those transactions are based on a multiple of earnings. So when we think about that, is EBITDA what we're talking about when we say based on a multiple of earnings?
Yes, typically that's true. There are some, variations, but as you pointed out, the vast majority are based on EBITDA multiples. It is the best quick estimate of free cash flow that will be available to provide the return to investors and pay the banks. It is independent of the current debt structure. It's less dependent on accounting methods and less likely to be manipulated compared to other metrics. The one drawback it has is that it doesn't account for growth. So nothing's perfect, but it is the best thing out there, and is every deal that I've ever looked at, the first cut was always based on a multiple of EBITDA. After that, different buyers will look at things a little bit differently, but you start having the conversation at the very least based on an EBITDA multiple compared to industry, similar industry that the company's in. And because of the multiple effect, each dollar of EBITDA is more value than some owners realize. And for example, if you have an EBITDA change of $100,000 and you're in an industry that commands a 10 multiple, then you're talking about $1 million price difference. And so you've got to keep that in mind. It's not just the dollar of EBITDA that you may be changing. It's the price by whatever the multiple is.
Yes, that's absolutely right. I always tell folks that pay your taxes now, and a dollar to the bottom line is worth several more dollars to you at transaction time. And so be sure to focus on driving those earnings. Now, another adjustment that we typically see in a lot of small business transactions are what we call discretionary expenses. So what are discretionary expenses and how should they be treated in the valuation of a business?
So discretionary expenses really is a very broad spectrum of expenses. And quite frankly, some of them are legal and some of them are not, at least, and I'm really referring to from a tax perspective. Some examples of discretionary expenses are higher salaries for the owner compared to the market. So, for instance, if the company is paying the owner $300,000 and the market for having somebody run a company like that is $100,000, just to keep the number simple, then you could add back $200,000 because the buyer is going to say, I can hire somebody to replace the owner for $100,000. So there will be $200,000 that right now doesn't drop to the bottom line that will be available to pay me my return and banks what we owe them. So that's kind of the way a potential buyer would look at that, and an owner would suggest to the potential buyer that they should look at that. Other areas, one that falls into the probably not legal is salaries of relatives that don't actually work in the business. If you can document that the company was in fact charged those wages, and the relatives don't actually work in the business, then again, that would be money that would be available. Other things are higher than market rent. A lot of owners will have their company and the real estate that their company operates in different entities. They will own them separately, and they will charge the operating entity a rent for using that space. It could either be above market or below market, and so you would adjust EBITDA accordingly, whichever way it was. Private automobiles. A lot of companies have company automobiles that are necessary for operation of the business, but a lot of owners run their private automobiles that are really not used in the business through the company. And so that too would be something that wouldn't be an expenditure of the company after the new owner buys it. Children's educational expenses, sponsorships, improvements to non-business related properties. Sponsorships is kind of an interesting one. Let me go back to that for just a second. If a company sponsors, let's say a company, the son of the owner is one of the top 5 NASCAR drivers, might make sense for that company to sponsor them because they get really good marketing out of that. On the other hand, if that son or daughter is in a sport that doesn't provide as much exposure to the sponsorship, then it may not be worthwhile, and therefore wouldn't be something that a new owner would pay for, and therefore wouldn't be an expense of the company, and therefore adjusting EBITDA up because that wouldn't be an expense would increase the EBITDA and therefore make the value of the company higher. So discretionary expenses should be added back to increase EBITDA when they won't be expenditure by the business after the new owner takes over.
So I want to expand on a couple of those things that you just said. So owner's comp. I frequently hear from business owners that they just want to add back their entire compensation, but you made an excellent point that a buyer is going to not add back the portion of the owner compensation that he'll have to pay somebody else to do that work, or he'll have to pay himself, right, to do that work. And so typically, owner compensation is not fully added back. Is that, and I think based on what you said, you'd agree with that. Am I correct?
Absolutely.
Yeah. So, I mean, you might have an owner that's paying themselves $1 million, but for a business that size, perhaps they could get away with a $200,000 person running that business. Well, that's an $800,000 add back, not $1 million add back. And so I wanted to highlight that point. The other thing that you mentioned here that it just occurred to me is when a business owner owns real estate kind of in separate entities and they're paying that, and if they're paying below market rates, then that actually is going to, when you restate the earnings and handle the discretionary expenses, that means you're going to be adding back cost, right? So reducing the earnings. So am I right in that?
Absolutely. And that happens as frequently as the other way, quite frankly.
Yeah, absolutely. I've seen it very frequently. So, because if they own the building and let's say the buyer is not going to buy the real estate, they're only buying the business, but they're going to rent the real estate. Well, the owner's not going to give them an advantaged rate. They're going to charge them market rates for that. So you've got to add that cost back in, and thus reducing the earnings. And so it's a kind of a nuance there that business owners should be thinking about. Look, most small business owners have discretionary expenses, right? And other than the folks that are not working kind of in the business, which scares me. By the way, I do a little bit of buyer representation for some of our clients. I'm doing some due diligence and some work for some clients that are acquiring businesses. And in one case recently, I had a business that my client was attempting to buy. And when I asked for a schedule of the discretionary expenses, I got things ranging from, of course, automobiles for himself and for his family who were not working in the business, cell phones for everybody. But then I had the pool guy, the housekeeper, the lawn guy, and those things that they were running through the business and expecting to be able to add those things kind of back in. One of the things that I tell business owners frequently is buyers get adjustment fatigue. If you're doing all of those things and running that stuff through your business now, it's unlikely that a buyer is going to give you full credit for all of that stuff because it's hard to document and add back. And frankly, it frustrates them when they see adjustments that look like that. My advice typically is get most of that stuff off of the books and pay the taxes on it now, right? Because you can increase those earnings and get paid back. So in your professional opinion, is it okay for a business to have discretionary expenses, or should they minimize those expenses?
Well, I think it's okay for them to have discretionary expenses, but as you pointed out, at some point, potential buyers may experience add back fatigue, or I think you used a slightly different term for that, but it's fatigue in this area. Whenever you're trying to add back too many discretionary expenses, especially when, and you're right, they're not going to get credit for them if they're not clearly documented and they can't easily be traced through the general ledger so that it's clear that in fact those expenses did reduce the net income of the company. So there's kind of a balance that needs to be maintained between giving up value by not claiming legitimate discretionary expenses as add backs to EBITDA, while not causing potential buyers to become frustrated by having to track down too many add backs.
Right. It's so important for business owners to really understand those and dive in and attempt to minimize that kind of thing long before that's time for a transaction, so that those are gone out of the books. And by the way, most buyers are going to look at 3 years of financials. So don't think you can make those adjustments in 1 year and it'd be okay, because then you're going to also be reconciling all those other adjustments. So I say try and do those things at least 3 years before a transaction, so that they're not on the books that people are asking for, right? Awesome. Hey, that is a lot of great information on EBITDA. We're going to change gears after the break. We're talking with Craig Beck. We'll take a quick break. We'll be back in 30 seconds.
Every business will eventually transition, some internally to employees and managers, and some externally to third-party buyers. Mastery Partners equips business owners to maximize business value so they can transition their businesses on their terms using our 4-step process. We start with a snapshot of where your business is today. Then we help you understand where you want to be and design a custom strategy to get you there. Next, we help you execute that strategy with the assistance of our amazing resource network. And ultimately, you'll be able to transition your business on your terms. What are you waiting for? More time? More revenue? If you want to maximize your business value, it takes time. Now is that time. Get started today by checking us out at www.masterypartners.com or email us at info@masterypartners.com to learn more.
We're back with Craig Beck, founder of Beyond CFO. Before the break, we talked about EBITDA, earnings before taxes, interest, depreciation, and amortization. So let's change gears and talk about working capital. How do you calculate working capital? Is it a formula that can be used in virtually any business?
There is a typical GAAP accounting formula for working capital, and simply current assets minus current liabilities, which are those that are expected to occur within the next year. But while working capital with regard to a business transaction is related to that formula, it can be, and most often is in my experience, a much more complex assessment and calculation.
So is it the same for almost any business then, or is it really dependent on what type of business that you're in if you're making those calculations for a transaction?
Well, so the definition in my view, for a transaction is similar, but when you start to get into the details, there are a lot of nuances, not only with regard to the type of business, but with regard to an individual business. But the business transition working capital equation is operating current assets minus operating current liabilities, or maybe in layman terms would be the cash that the buyer will need to operate the company in the normal course of business after he takes over the company. So like I mentioned there, as you asked, there are nuances by type of business, but the individual business creates probably as many as the type of business. And it's usually related to the way a company accounts for certain transactions in the normal course of business. So some examples of that are, I've seen a company recently that was a target of one of my clients that had recognized revenue last year. They'd signed a contract to provide services for 1 year, and they had recognized that revenue last year. So when we looked at the financials, the EBITDA was up because of that revenue. But then they didn't reflect the corresponding liability on their current year balance sheet and they needed to, because they had the cost of supplying those services in this year. And so it was kind of a double whammy. And so you've got to be careful about something like that. Other more typical examples are accounts receivable overstated, and if they are, that means that they're not going to bring in as much cash after closing as what you might expect. In other words, is there a history of bad debt in the past that's, the customers are the same, and so you should expect roughly the same bad debt, but it's not accounted for anywhere in the financials. Likewise, are the accounts payable understated, which would require more cash than expected after the closing. That's usually looked at through the quality of earnings due diligence phase. Another area is inventory overstated, or is it obsolete? If it's obsolete, you're not going to use it to create your finished goods, and therefore you're not going to get future value that you would expect, because you're not you're not generating the expected cash. So those are kind of typical, maybe one not so typical, but the other ones are fairly typical things that you need to make sure you look at.
I'll tell you, one of the common things that I see, businesses that have inventory, unless they're really on top of it and doing their cycle counts, random counts, and making sure that everything on the shelf is sellable. A lot of times businesses just let inventory get out of control. Now, I find that sometimes that's because of their banking relationship. They want that inventory on their balance sheet because it supports like a line of credit or something like that. But I can give you example after example of doing inventory on an acquisition and making significant adjustments for what I call dead inventory that hadn't moved in over a year, and I've actually derailed some acquisitions just on the inventory issue alone. And so pay really close attention to the inventory. One of the things that I think is fairly common too, and there's a correlation between the size of the business and this issue. The smaller the business, the more surprised buyers are that there might be a working capital component to an acquisition. A lot of business owners, when we've done acquisitions, there's always a working capital component. I've done 100 transactions. When companies are buying when I'm selling my businesses or when I'm buying businesses, there's always a working capital requirement there because you're buying an ongoing concern and you need to have the capital in order to continue to operate the business for some reasonable amount of time, right? And so if you've got good AR that's going to pay, that'll bring cash into the business. If you've got a reasonable handle on the AP, but most business owners, when I have that first conversation with them about working capital components, they're like, "What do you mean? I'm just going to sell the business and they have to bring their own cash." I had to do this when I started up. Now, you've done a lot of transactions as well. I know that you in your business that you've supported a lot even prior to starting Beyond CFO. I just want to get your perspective on, do you see a working capital component frequently in M&A transactions?
Always.
Okay. I was going to say most of the time, but I agree. I think it's almost always there. Sometimes if you're buying a tiny little business and it's just buying the assets, I have done some acquisitions without it, but you were starting to say something there.
Yeah. I was going to say, it's either there explicitly or it's there implicitly, but it's always there.
Oh yeah. Okay. All right.
Because if it's not there, there's some adjustment to price. So it's there implicitly when that price is adjusted because there's no working capital.
Yeah. It's interesting. And I got into a really lengthy and almost heated debate in my last sale of a business. The working capital request that they put on the LOI was significantly higher than what we knew the business needed to operate. So they were using that as an opportunity to basically lower the price, right, by requiring a high working capital component. But we were ultimately able to negotiate that to be something that we felt like was reasonable. Our business was a recurring revenue business. 80% of our revenue was recurring revenue. And twice a month we'd push a button and money would just flow into our bank account. So we had very predictable income. And a working capital component might be more complex for a business that doesn't have that recurring revenue. And so we were able to successfully reduce that. It didn't get as far as I wanted it to go. And I'm a skilled negotiator when it comes to doing a transaction. So I love the fact that my good friend Craig Beck says it's always there. So business owners, when you're planning for a transition, please do not be surprised if there is a line item on an LOI that talks about a working capital requirement. And so think about those things and get advisors who can help you understand that because when you see that, many times it becomes a very emotional thing for a business owner, and sometimes it derails deals. But you just heard it from somebody who is in the know. It's always there, whether it's written on the document or whether they're reducing the price as a result of it. Then they're going to get the working capital they need to operate the business. I think I can't overstate that. Would you agree with that, Craig?
I would agree with that. And there's, if you don't mind, there's one other thing I'd like to point out on inventory that is not directly, at least initially, related to a transition. Ultimately, it would be. But one of the things I discovered is that a lot of companies that have their financials prepared only for the purpose of getting their taxes done won't have, and this specifically applied to a mining company that was a client of mine. They won't have any inventory on their balance sheet because all of that will have been expensed. The problem with that is that when if you use that balance sheet to go to a bank to get a loan, particularly a line of credit that is often dependent upon equipment value, accounts receivable, and inventory, you've knocked out a big portion of your potential borrowing base for a line of credit specifically. And that client had a small line of credit with the bank based on equipment and an accounts receivable, but they had no inventory. And when we redid their accounting, we changed that and created, we basically got about $1.3 million of inventory on the books, and because it was finished inventory at that point, the bank was willing to loan 70% against that. So we were able to expand their borrowing base significantly for a relatively simple reason. Now that'll ultimately affect the transition transaction because that's an asset that's on the books that wasn't on the books before. So just thought I'd point out kind of another issue with not dealing with inventory properly.
I agree completely. One of the things I some time ago joined an advisory board for a business that was basically expensing all of their inventory, which is fine if you're buying the inventory and using it and then charging for it, in the same month. But I looked at the first time I looked at their financial statements, I was seeing these outrageous swings in their gross profitability, right? So revenue less, cost of goods sold and a few other things, but gross profit. And I was seeing things from, 50% to minus 20%. And it was all tied to that, to cost of goods sold. So they were expensing everything. I said, no, we need the expense to line up with the revenue. When I see these wild swings in gross profitability, it tells me that something is not right. Now, in this particular business, I nailed it down right away to the inventory. But have you seen that before? And is that something that business owners frequently do?
Ones that haven't converted to accrual accounting, I see it all the time.
Oh yeah, they're cash accounting, right, for tax purposes and that kind of thing.
Right.
I always say, and I run the risk here because you're a much keener financial mind than I am. But I tell business owners, if I'm looking at their books and their cash accounting, I go, look, you can't manage the business on cash accounting. You need to manage the business using accrual accounting, and we pay our taxes based on cash accounting, and you should be operating that way. Now, I made that statement at great risk. Are you going to say that I'm all wet here?
No, I think you're absolutely right. In fact, I tell my clients that there are actually three. Most people tell people that there are two sets of books, tax books and kind of GAAP books. But I tell my clients there are really three sets of books: tax, GAAP, and management, because you need a little bit different information. It's close to GAAP, but you need a little bit different information to run your business than even a GAAP set of financials will give you. But a tax set of financials, as you pointed out, is really inadequate to run the business by.
You just can't operate the business. You can't make decisions based on what you're seeing on cash financial statements. At least I don't think that you can. And so it's so much easier to look at it the other way. So, before we wrap up here, is there any other wisdom you want to impart to us about why working capital is important?
I think it's important. We touched on one of them. I think it's important because the buyer, if it's not calculated right, he may have insufficient funds to operate the business after closing. And if that's the case, he's probably overpaid for the business. So it's kind of a double whammy there.
Yeah, I totally agree. So pay attention to that working capital. So one last question before we wrap up here, Craig. This podcast is all about maximizing business value. I know that is near and dear to your heart as much as it is to mine. You had to give business owner just one thing. What is the one most important thing that you think business owners should do to maximize value in their business?
I think they need to understand where they bring the highest value to the company. I see a lot of owners getting distracted, and when they were smaller, they could afford to do that, but as they grow, they can't. And then don't let anything distract you from focus on that area. I think about people in the business that are kind of in three categories: finders, minders, and grinders. And that's the owner of B2B CFO kind of came up with those terms. But the owners are the finders of new customers and new ideas. They've got minders of the business that are absolutely necessary to keep things rolling, and then they got the people on the shop floor that are the grinders. They don't need to be minders or grinders. They need to be finders and to produce that highest value. So focus on that, and don't let yourself get distracted like you may have let yourself do when the company was smaller.
I've heard you use that term before, and that comes from your old business, B2B CFO. I didn't realize that it came from there. So finders, minders, and grinders. I like that. It's three folks. It also lines up really well with our mutual friend, Mike Rose, his book, ROE, which talks about kind of those three roles. He calls them way one, way two, and way three, right, which in essence are the finders, minders, and grinders. And so there's lots of evidence about which one of those. I love that. Whatever you're great at, go do that and find somebody else to do the other stuff.
Right.
That is such great advice to business owners. So I'm not going to let you off the hook, though. I always ask this question. I have to ask you a bonus question, Craig. What personality trait has gotten you into the most trouble through the years?
Well, I'm not sure it's a personality trait that's got me in more trouble, but it's one which has probably cost me more money over the years than anything else. And that's the failure to remember that perfect is the enemy of good, which is Voltaire, and that done is better than perfect, which is Sheryl Sandberg. So those are things that I remind myself almost daily of today, and it's changing the way that I look at things. I wish I would have begun to do that 20 years ago or more.
Yeah, it's almost an obsession for folks that are I hesitate to use the label, but perfectionists, right? They want it to be perfect and get it right. But to me, that just gets in the way of getting it done. I am so fortunate that that's never been a part of my personality. I would rather be done than perfect, and it's gotten me in trouble probably fewer times than trying to make it perfect, right? So that is great advice for business owners. I love that. So how our listeners and viewers might want to get in touch with you, how can they do that?
Well, they can always call me. My cell phone number is 630-240-1383, or they can reach me at Craig Beck at beyond-cfo.com. You can take a look at my website at beyond-cfo.com, or you can look me up on LinkedIn.
Awesome. Those are 4 great ways, and I'm going to give them one more way. Thank you, Craig, for being our guest today. This has been a great pleasure and a great education for business owners. Thanks for being with us.
Thanks for having me.
You can find Craig Beck at beyond-cfo.com or on LinkedIn. But of course, you can always feel free to reach out directly to me, and I will give you a warm introduction to my close friend, Craig Beck. This is the Maximize Business Value podcast, where we give practical advice to business owners on how to build long-term sustainable value in their businesses. So be sure to tune in each week and follow us wherever you found this podcast, and give us a comment or a suggestion, something that you'd like to hear on a future podcast. We respond to all of those. Until next time, I'm Tom Bronson, reminding you to spend time to really understand EBITDA and working capital while you maximize business value.
Thank you for tuning into the Maximize Business Value podcast with Tom Bronson. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition on their terms. Learn more on how to build long-term sustainable business value and get free value-building tools by visiting our website, www.masterypartners.com. That's master with a Y, masterypartners.com. Check it out.
That was perfect. I wouldn't make any changes on that.